Extending a hand in support of a more dovish monetary policy stance, Federal Reserve Chairman Jerome Powell signaled a pause in rate hikes in 2019. On November 28th, Mr. Powell tempered previous remarks about raising interest rates, and that same day, newly released inflation data lent support to the Fed chair's more dovish stance. Here's a financial news update. Minutes of the Fed's meeting held earlier this month were released and indicated that a planned rate hike for December is still likely to occur. However, a pause was widely expected following the Fed chairman's speech and new government reports on inflation, consumers, and the endurance of the 113-month-long expansion. Inflation dropped in the 12 months ending in September and declined compared to the 12-month rate in August and July. The core personal consumption expenditure deflator is a key inflation metric to the Fed, and it's different from the consumer price index used in the media. The 1.8% core PCED is down from September's 2.0%. Inflation declined, but the economy shows signs of fundamental strength. Consumer spending and disposable personal income continued trending higher, and yet the savings rate also continued to trend higher than in the last economic expansion. This suggests that Americans are in good shape, and since consumers account for 70% of the economy, this is a key piece of data. The 4.8% DPI figures for the most recent 12 months through October is lower than the 5.3% averaged annually in the last expansion, but these figures are before adjusting for inflation. Meanwhile, consumers have been saving more than they did in the last expansion. Adjusted for inflation, real DPI per capita is higher than the rate in the last recession. That's an important statistic, and you do not see it in the media too often. Real DPI per capita recently grew at a faster rate than in the last economic expansion, and that was a strong boom cycle. Finally, the financial obligations ratio, another metric watched by the Fed, remained near a record low. Consumers through the end of June, where the most recent data is available, were in about as good shape financially as they've been in post-war history. The Fed's more dovish stance and favorable economic news sent the Standard & Poor's 500 soaring, and just 5% from its all-time closing high on September 20th. No one can predict the next move up or down in the price of stocks. Stock market volatility has been much higher in recent months and is likely to continue as the long economic expansion continues.